If you're a small business owner in South Africa, you know that feeling, that end of February scramble. It can feel like a financial storm is brewing, but what if it didn't have to be? Well, in this explainer, we're going to break down how you can turn that year-end tax chaos into a smooth, simple process that actually protects your business and, more importantly, your bottom line.
So here's the plan. We'll kick things off with the real financial risks of getting this wrong. Then we'll clarify the basics of the tax year, dive into the most common and expensive mistakes people make, and then, the good part, we'll give you a clear rescue plan with a checklist and some best practices to help you stay ahead of the game.
Right, let's get straight into it. You know, putting off your taxes doesn't just create a mountain of stress, it has a real price tag. That February 28th deadline, it's not just another date on the calendar. For your business, it's a critical financial checkpoint you just can't afford to miss.
So let me ask you a direct question. Are you leaving money on the table this tax season? Or maybe even worse, are you unknowingly setting your business up for some hefty penalties all because of small, completely avoidable oversights?
Because look, when you add it all up, the penalties for underestimating, the interest on late payments, and all the deductions you might miss out on, these simple errors can easily cost a small business over 50,000 Rand. But here's the good news. Every single one of these mistakes is preventable.
To win any game, you've got to know the rules first, right? So let's just take a quick second to get everyone on the same page about how the South African tax year actually works for most companies out there.
So your financial year-end is basically the closing date for your books. For the vast majority of businesses here in South Africa, that cycle runs from the 1st of March all the way through to the last day of February. That's the period that you're accounting for.
Let's just map out the whole year so it's crystal clear. Everything kicks off on March 1st. Then, by the end of August, your first provisional tax payment is due. Next thing you know, it's February 28th, which marks the end of the tax year and the deadline for that crucial second provisional payment. And you're not done yet. Don't forget that big payroll reconciliation, the EMP 501. That's due by the end of May.
All right, now for the danger zone. Let's talk about the foremost common, and believe me, costly mistakes we see businesses making time and time again as that February deadline gets closer.
First up is the travel logbook. Now, this is one of the biggest tax deductions you can get, but it's also the place where SARS finds the most mistakes. A lot of business owners think just jotting down client meeting is good enough. I'm here to tell you, it's not.
And this is where it really hurts. If you get your logbook wrong, if it's not perfect in SARS compliance, you don't just lose part of the deduction, you lose the entire thing. So that 60,000 Rand travel allowance suddenly becomes fully taxable, costing you over 18,000 Rand in extra tax. And it really is all in the details. SARS wants the person's name, their company, the reason for the visit. Even just missing your opening or closing odometer reading can make your whole year's claim invalid.
Okay, mistake number 2, the Employment Tax Incentive, or ETI. This is honestly one of the best cash flow benefits out there for hiring young workers, but so many businesses either don't claim it at all or they claim it incorrectly. They're just leaving real money on the table.
I'm not kidding. We're talking about a potential benefit of up to 30,000 Rand for each qualifying employee per year. And this isn't a deduction. It's a direct reduction of the pay you owe to SARS, which means more actual cash in your bank account every single month. But if you miss the claim deadlines, that money is gone for good.
Oh, this next mistake, it catches so many people off guard because it just feels wrong. It's totally counterintuitive. It's all about when you have to recognize a capital gain from selling an asset, like a piece of property. So here's the crucial point that trips everyone up. Most people believe the tax is due when the asset officially transfers hands. Makes sense, right? But the reality? SARS triggers the capital gains tax event on the day you sign the sale agreement. So, if you sign a deal in February, that gain belongs in this tax year, even if the transfer only happens months later in, say, June.
And that brings us to our final and maybe the most critical mistake of all, underestimating your provisional tax. We're talking specifically about that all-important second payment in February.
You know, this quote from a tax advisor really says it all. SARS looks at your August estimate very differently than your February one. By February, they expect you to have a really good handle on your numbers. That whole, we'll just fix it later mindset, that can lead you straight into a hefty 20% underestimation penalty, not to mention all the interest on top.
Okay, enough about the problems. That's enough doom and gloom. Let's move on to the solution. This is your rescue plan.
A simple, straightforward checklist to get your business on the right track for a compliant and, dare I say, stress-free year-end. First things first, let's lock down the foundations, your financial records. This means you need to reconcile every single bank account. You've got to review who owes you money and who you owe money to. Formally write off any of those bad debts you know you're never going to collect, and this is key. Make sure you've captured every last business expense. Next up, let's talk payroll. You absolutely need to reconcile your monthly declarations for PAYE, UIF, and SDL against what you've actually paid to SARS. Then, you need to get everything ready to issue IRP-5 certificates to your staff. And always remember that big annual EMP 501 declaration is due by May 31st. Don't forget it.
And finally, we have documentation and planning. This means getting all your source documents, all the invoices, the slips, the receipts, all neat and organized. You'll want to update your asset register with any new things you bought and calculate the depreciation for the year. And most importantly, use all of this great info to accurately forecast and calculate that final provisional tax payment.
Okay, so once you've got the basics down, it's time for the pro move. Let's shift from just thinking about compliance to thinking about smart business management. This is all about working smarter, not harder, to make your year-end feel like a total non-event.
You know, this quote really boils it all down, doesn't it? It's not about being some kind of tax wizard. It's simply about knowing what you need to do, staying organized, and acting early. That's it.
So what can you do? Here are 3 real, actionable steps. First, adopt some kind of cloud accounting software. It gives you a live look at your finances. It's a game changer. Second, make record-keeping a habit you do all year round, not just a frantic panic in February. And third, if you're feeling overwhelmed, just talk to a tax professional. Their advice honestly pays for itself many, many times over.
So let's end with this question. The difference between a stressful tax season and a smooth one is just one thing: preparation. Don't wait for the deadline to be staring you in the face. What is the one action you can take today to prepare for your year-end? Can you reconcile one account? Update your logbook? Maybe just make that call to your accountant. That first small step is always the most important one.